You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Santa Barbara, California, Montecito to be specific. And before we start today's show, I want to remind you that there is a website associated with this podcast called wealthformula.com. Lots of resources there. Check it out. Lots of videos, books, online books, that kind of stuff there. And that's also where you're going to join the various lists that are associated with this podcast, such as the Accredited Investor Club. If you're tired of having lazy money sitting on the sideline and you're an accredited investor, come join the party. Join our Wealth Formula Accredited Investor Club. Also, there is a group called Wealth Formula Network. It's a course, actually. It starts with a course called Your Roadmap to Real Wealth, and then phases into a community, an online community that is on Facebook and all that, but also, more importantly, has bi-weekly Zoom video conference calls that people really seem to enjoy. You can check that out. There's a dedicated site for that as well at wealthformularoadmap.com. Now, this podcast is sort of, we did Ask Buck last week, and then, I was going to do another one, but then, I thought I'd mix it up. And we have Jorge Newbery wanted to get on and talk a little bit about what's going on. I thought it was a good idea. So we'll sort of come in and out with all the Ask Buck questions. And if you want to keep asking them, go to wealthformula.com. And I think there's a little thing there that says leave Buck a message or something like that. Go ahead and ask your question there. That's ideally how you want to do it. Last week, great questions. I thought it was a really useful show, by the way. So this week, of course, we have Jorge Newbery today on the show, and he's a guy who talks a lot about, he's an expert, really, I think, on the single-family home market in particular. The residential real estate market is on fire. What's going to happen in the future? I don't know. There's this great Yogi Berra quote I love. He says, "It's tough to make predictions, especially about the future." Anyway, that's Yogi Berra. Good stuff. No doubt he's right. We are seeing massive growth and expansion across the board, from single-family homes to massive apartment complexes. Prices are going crazy. And I'll tell you, these are different animals too. I'm not an expert on single-family homes like George at all. I don't understand them. They're not rooted in, net operating incomes and cap rates and stuff like that. However, I can comment on larger residential real estate. And as you know, cap rates have gone down. They've gone down a lot. And it's because mortgage interest rates are also at historic lows. I mean, this is just math, right? This stuff, it just doesn't just happen. People say, oh, it's low cap rates, and I don't wait till there's high cap rates and buy then. But what is it anyway? What is this whole cap rate thing? It's basically following interest rates. It's just math, right? Leverage only works if the money you borrow, it's less expensive than the cap rate. So in other words, the cap rate has to be less than the interest rate. I'm sorry, the interest rate has to be less than the cap rate. See, I'm confusing you already. The interest rate has to be less than the cap rate. Otherwise, you are leveraging losses, not profits. So think about that. All right, that's an important thing. So that's driving cap rates. If the interest rates are low, then we can get to a lower cap rate, right? Because as long as we have positive leverage, it works. So the question I often get from investors is, what if interest rates go up? And it's actually a good question. We have to understand that there's no component, though, of the economy that happens just in a vacuum, right? You don't have escaped interest rates and everything else is the same. It doesn't happen that way. Cap rates are low because interest rates are low. Interest rates are low to avoid asset deflation, and the Fed is controlling mortgage interest rates by buying up 10-year Treasury bonds. The 10-year Treasury typically reflects inflation. If it goes up, that means we've got inflation on the horizon. So even if cap rates go up following increased mortgage interest rates, we should be able to raise our rents because of inflation to match that inflation and offset the negative impact on us as sellers who now are dealing with increased cap rates. Now go back and listen to that. I know it might be a little confusing, but listen to it in slow motion. No, I know a lot of you listen to me in fast motion because I talk slow, but you may want to listen to that one slower. Anyway, that's why I consider apartment complexes to be a hedge against inflation. But the reality is that the economy right now is unpredictable and it's pretty darn fragile too. Okay, so the likelihood of the Federal Reserve allowing interest rates to just sort of naturally creep up, to me, seems unlikely, as any downward trends in the economy or anything that resembles any kind of shock to the economy will almost certainly result in a knee-jerk response of economic stimulation. Now, of course, I could be wrong. Of course I can, because like Yogi Berra said, it is very difficult to predict anything, especially about the future. But my personal feeling is that we have, I think that we have a runway of about good 5 years or more before the party ends. That's what I really believe, okay? That's not financial advice. It's just what I think is going to happen. So what do you do? So what do you do now? Well, again, I'm not going to give you investing advice, but I'll tell you what I'm doing. I'm doing what I always do. I'm investing in value-add real estate that does not rely on market appreciation to be profitable. We're not just going to buy stuff and hope. Buy and hope is not a good strategy. If the market keeps heading north, then great. If not, it's not the end of the world, because what we do and what I invest in is value-add real estate where we actually create equity. Right? So the bottom line, in my view, is that a reasonable approach to this, strange world economy that we live in is to continue volume averaging into investments, because the problem is not investing in an inflationary environment also guarantees the loss of your buying power. So you don't have a lot of choices. And people who guessed on this and decided not to invest, man, they have lost so much money, because in the last 6-7 years, there's like some major players out there who just stopped buying, right? Because they say interest rates are low, cap rates are low, and they just assumed, that it was, time to stop. And man, oh man, a lot of money that was not made during that period of time. So obviously, I have a perspective on this. My friend Jorge Newbery is, he's less enthusiastic about the market. And obviously, he's talking about the single-family market. And all these are all interconnected. Even the stock market's connected with real estate too. But he's, he's a little bit more pessimistic, at least in a shorter period of time than I am. And he's looking at making some, other choices. And on this week's Wealth Formula podcast, George comes back to the show and he gives us perspective on the real estate market and his formula to come out ahead either way. And so we will have George right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast is Jorge Newbery. You've probably heard of George before. He's been on the show, I don't know how many times, certainly a record for the number of appearances on a Wealth Formula podcast. He's been a supporter of Wealth Formula podcast since the beginning, even when we only had 5 or 6 listeners. Of course, he didn't know that at the time, so it didn't hurt him. George, welcome back to the show.
Thanks, Buck. It's a pleasure to be back. I'm trying to put my distance between myself and the second place guest in terms of number of appearances on your show.
I don't even know who that would be, honestly. So it's probably me. I mean, I probably second place. But how's it going? Obviously, George, we know you as as the founder of probably most well-known to everybody, is the founder of American Homeowner Preservation, which became AHP Servicing, then PreReo. So you are in, of course, the business of ultimately of non-performing notes, non-performing properties, and all that stuff. So let me just ask you, what the heck is going on right now? We just came off the pandemic and all this stuff. What's going on in the real estate market?
Yeah, it's fascinating to me. When COVID first started, I think at that point, before it had started, people were thinking, "Hey, we're at the end of a long upcycle." The market had been going up since 2011, 2012, 2013, and it was ripe for a reason to go the other direction and prices to decline. And instead, the complete opposite happened. I mean, that's not news to anybody, but the market's been on fire for the last year and a half, and property values have gone up by and large 20%, some areas 30%, and almost like all areas, all properties. It's been just an extraordinary situation, and that's been helpful. I mean, the reality, it's been helpful to our companies. What's happened? The beginning of COVID was challenging, as it was for everybody. But I have to say, I'm growing increasingly concerned that there will be a downturn. This has to end, and the fact that it's gone up so high, I think there's a significant disruption in our future. How soon, I don't know. I mean, the economy is so fragile; it's likely that interest rates will stay low for an extended period. But at some point, this has to change, and I think there's. Probably the most at-risk buyers are probably those buying today, especially on those properties that have appreciated the greatest in the last 18 months.
Is it the same across the board in the country, or is it mostly in certain areas?
No, we see it. I mean, it's almost across the board in almost all areas, of the country, and also all price ranges. There's just been this extraordinary demand, and also extraordinarily cheap money. Federal money, stimulus money, PPP, other kinds of monies that have flooded the system have, I think, all contributed to the phenomenon that we're seeing today.
Yeah, and it's interesting. So this is I remember, I think last time we had you on, which wasn't that long ago. I mean, it was more sort of in the heart of the pandemic, but I think you were anticipating sort of the opposite, right? You were anticipating then, because of historical precedents, that we would have a lot of, a lot more REOs, a lot more distress in the market.
Yeah, well, I still anticipate that happening. It's just, I'll be right. It's just, we're not sure when. But one day you'll say, I was right. I'll probably call it too early.
Oh, don't be one of those guys.
But foreclosure moratoriums are still in place in many parts of the country. They have started lifting in some states, but that is, kind of holding back inventory, and keeping, creating scarcity, which drives values up, demand and values up. So that is there's a lot of unknowns. I think for everybody, it's hard to predict a market where there's a lot of, I would almost say, artificial factors in play. These extremely low interest rates, foreclosure moratoriums, things that usually aren't weaved into the equation, or now you have to kind of weave them in. And even when these foreclosure moratoriums end, it's going to be interesting to see. I don't think there's, and in fairness, some of them have already ended, but we have not seen a mass start of foreclosures. I think there's huge pressure, and rightfully so. There's huge pressure from regulators and our governments to do everything we can, even once the foreclosure moratoriums lift, do everything we can to keep families in their homes. And I think there's already a decent amount of federal money that's earmarked to support those efforts and maybe help families catch up on some of their payments, or do other things, to incentives to servicers to do mods. I think these are tools that are likely to come into play. And even once all the moratoriums are lifted, and foreclosures could all start in mass, I don't think we'll see that happening. So that could extend this for another 6 to 12 months, even once there's no barriers to foreclosure.
Single family houses are a lot harder to understand for me, and because there's really no, you don't really deal with cap rates and all that. I mean, it's really what people anticipate they're worth, right? I mean, so it's challenging, but certainly one of the things that I think and you mentioned this, what's driving the market here is really, really cheap money, really low interest rates, right? Absolutely. The challenge to me is trying to understand, I don't really see interest rates, going higher for some time, right? And so with that in mind, you mentioned obviously you've got the moratoriums and all that, but you also have a lot of interested investors, a lot of free money flowing out there. This thing could last a lot longer than we anticipate.
Yeah, it could. I think but investors are also, a lot of what drives it is emotion, and people get nervous or get scared, and vice versa, get very comfortable, like many people are today. Some people who have just been investing the last few years maybe thinking this is easy. I mean, I just buy something and it goes up in value, I sell it or refinance it, and that's easy. But it's not always like that way. It's not always that way. At some point, there will be a downturn where just as easy to make money, it become just as easy to lose money. So although I don't see the factors like the interest rates, it's very difficult to raise them when the economy is as challenged as it still is, or at least many sectors are. So agreed on that, but it may be something different. It may be something that, like COVID, kind of came and most people didn't anticipate something like that. And so I don't think anyone anticipated the extent of it. What's next? What is the
China Everglades?
Yeah, no, you're right. That story, I've only had a few people share that with me, but you go, wow. Not that many people are talking about it, but those that are, it's pretty extraordinary. And so let's see what is, what's the trigger event is, the inciting incident that turns us down. And it won't be something that necessarily that's a reasonable thing. It's something that comes out and all of a sudden everybody says, wait, this doesn't make sense. Because the reality is the prices that some buyers are paying today don't make sense. You can only justify it with the cheap money. So the payments may make sense, but the problem is, we'll see what happened in last downturn where you had some strategic defaults. I won't say a lot, but you had a decent percentage of strategic defaults, people who could afford to pay their payment, but chose not to because in their mind they're saying, hey, why am I paying on a $500,000 mortgage when my property is only worth $300,000? And that situation is likely to return, and it's not going to return to the, I hate to say, but it's like a pyramid scheme of sorts. The real estate market where everybody wins, but that last group of people, the last buyers in, are the ones that take the hit. It all tumbles down. They start it over. And there's you could argue that, there's been a history of this up and down cycle where the last people in are the ones that take the hit. In fairness, some of those people, if they can hold on, they do well in time. Right. If you held on to your home through the 2008 crisis, chances are it's probably regained all of its value and then some today. But that's a long stretch. That's a good 13 years since 2008.
Right. The interesting thing to me is that, we talk about this in normal times. I would listen to what you're saying, and that's just that's the cycles. He's looking at the cycles, but we live in really unusual times in terms of, fiscal, monetary policies, and things aren't doing what they would normally do. I mean, we just got through what should have been an absolutely devastating economy with the pandemic, yet artificial money, all of these creative means of keeping the economy afloat. Are you convinced that we're not in a place like that where we're just, I guess Marin Katusa, for example, would call this sort of a modern monetary theory where you just don't even worry about debt anymore. You just keep pumping money into the economy and keeping it afloat. Is this, are you convinced that we aren't in different times now and that this follows historical precedents?
I'm not convinced. I'm not convinced that this is anything different. So every time we hit this high point and people look back and say, well, history has always done this, but this time it's different. And here's why. And they'll list a number of reasons why. And people in 2008 were arguing, this time is different. Here's why. And it really wasn't. And there were a lot of, and I'll actually say 2007, but there was a lot of some of the brightest people in the country, a lot of people on, some of the Wall Street banks analysts were creating models saying, no, this is going to sustain itself. And I think it's just unreasonable to say that this time will be different. I think it's the same story. And there's definitely some different ingredients today, some different storylines. I mean, COVID is an extraordinary one, the flood of cash, the ultra low interest rates, foreclosure moratoriums, all these things, some of which we'll probably see once in our lifetime, have been put in place. And that is, I think that will delay the inevitable downturn in the market. I think that not only will delay, they have delayed the inevitable downturn in the market, and I think the cycle will go back down. And I don't think this is different. And I think people should prepare that this isn't different. If you're making investments, be cautious and think short term. I would think, because the longer term is there will be significant disruption in what's happening today. And if you think short term, if you can get in and out fairly soon, that works. If you're anyone starting a long-term construction project that's going to take 3 years today, I'd be concerned that at some point in that 3 years, the market changes, and all of a sudden, whatever you're projecting for the exit is going to be tough to achieve.
Yeah.
And we're doing this, and I'll tell you our strategy over the next 3 months through the end of the year for AHP Servicing and 2015 A+. They both have benefited substantially from what's happened in the market over the last 18 months. We are trying to exit our positions. Our goal is to sell, dispose of all our assets into a very favorable market. So if we're a reperforming loan, we're selling those. If we have an REO, obviously those are hard to keep on the shelves. They're selling very fast. And then the non-performing loans, if we see that it's going to take longer than the end of the year to exit, we're considering selling those as well, because I think the values that, and I may be calling the market early, but the values that we see and I expect will still be here for the remainder of the year. I don't know if they'll be here throughout next year. And so for us to exit those positions now and sell those assets and take our gains and move on to the next two funds, which is what we're doing right now. And the next two funds have strategies that are built for what we anticipate entering into that at some point in the fund's life will enter into a downturn.
And how long are those funds?
They're both 5-year funds. Mm-hmm. And I'll tell you the two strategies because it's what we think is the appropriate thing to do right now. So PreReo is a marketplace for defaulted mortgages, and one of the big features of it is that we offer to finance investors' acquisition of defaulted mortgages with the investor putting 25% down, PreReo financing 75%. And that's what we do. That's the majority of the money that we're raising through our PreReo crowdfunding offering is to do just that. So think about this. The property value is $75,000. The property value is $100,000. If that's the case, in all likelihood, the local investor can buy that loan at $75,000, which is a 25% discount off what it's currently worth. For REO investors, very, very attractive. And then they put down 25% of the $75,000, which leaves us investing $56,000. Ordinarily, we would be the one investing around $75,000, but now we're investing $56,000. So even if that 100 drops to 90, 80, 75, we remain in what we believe will be a secured position that will weather whatever the next downturn is. That's our strategy on PreReo. On AHP,
if I can just stop you real quick, because that's one product, and that's at PreReo.com. And so the idea is, from the investor side, is that you've got a platform there with. So these are properties that are in foreclosure, or these are properties, and you are basically you have them on sale, and you're saying you put down 25%. We'll put up 75%, right? What are the terms typically on the debt there?
Sure. So we charge 12%. So investors pay us 12%. It's paid monthly, and then they get all the upside. And we've had PreReo up for just over a year, and a lot of people have made a lot of money buying loans, and the market's values have kept going up. So when they've exited, generally they have done extraordinarily well. One on a single PreReo, one investor shared it was the best single investment he's ever made in his life. He made more than $1 million on one single PreReo.
So are you buying the mortgage or in that?
Buying the mortgage.
Okay.
And I'll give you the numbers on that one because it's kind of extraordinary. It was about a $2.5 million mortgage, which he bought for $1.8 million, Singer Island, Florida. So very nice area. And he thought it was worth about 2.5 when he bought it. He bought the mortgage in October 2020. But, a few months later, he called me and said, hey, we're It was tenant occupied. He was completing the foreclosure, and he said, "Hey, the broker thinks I can sell this for $3 million." He was excited about that. A few months later, the tenant, he paid $25,000 to the tenant to move out. He did some repair work to the property, and he said, "Hey, the broker thinks I can sell for 3.5." This is this market that's occurred over the last 18 months. By the time he put it on the market at 3.5, he had multiple offers, including one all cash at over $3.8 million, and that's what he sold it for. So by the time, deducting all his costs and expenses, made over $1 million in less than a year on a single asset. So that's extraordinary. And a lot of other people have made, put down 25,000, for their 25% down and then double their money. We said stories like over and over of this stuff. And that's great that people are making money on it, but it's also, I think, a direct factor of the extraordinary real estate market that we've been in. So they bought, and 6 months later, the value's gone up 10-15%, and that has contributed a lot to this. I think the risk is when it goes the other direction, then people could be facing. People need to factor in, hey, there's a chance that values go the other direction. What's exciting to me about PreReo is right now, today, the majority of the assets are being sold by third parties. So we have third parties that are coming to our site, and there's some large Wall Street backed hedge funds that are now putting assets on the site. And we simply earn a fee in the middle for being the platform, a program fee, and we also earn the interest when we finance. And 95% of the people finance. It's a very high number. Only a few people pay cash because they like the leverage, and leverage is very uncommon in the note world. So that's what we've worked out, and it's, I think, for investors, we pay out 12. We charge 12%. We pay out investors 7%. So you can see how we make money. We make money on that on that spread, which covers the expenses, also gives us profit.
Okay, well, cool. That's at PreReo.com. That's certainly an interesting thing. And then you have something else you're doing. Talk
sure. So we're also buying a title insurance company, and so it's called AHP Title. It's another crowdfunding offering, similar situation where we're paying 7% to investors, $100 minimum investment, kind of very similar to some of our prior funds and almost identical to PreReo. But there's two primary uses of the money. One is we're buying a title insurance company, so not a title agent, but actually the insurance company. And then we're also we're buying a title insurance company, which is in one state. We're going to expand it nationwide. That's the number one strategy. Number two is we're buying defaulted mortgage loans. So very similar to AHP servicing, where we started a national mortgage servicer, and we also bought defaulted mortgages. But one big difference here, the defaulted mortgages that are being purchased or will be purchased by AHP Title will all be backed by our federal government in the form of FHA, VA, or USDA. So again, protecting for a potential downturn. To the extent there are losses on a loan that we buy, then there is the ability to file a claim with FHA, VA, USDA, and get reimbursed for all or part of that loss. So it is something which we see as repeatable and scalable and more predictable. Now, bear in mind, we buy these loans at discounts, just like we have always done. But we buy these at smaller discounts because the discounts are smaller because there's this federal backing, which covers all or part of any potential losses. And some of the losses, even like, hey, we buy a loan for 85 cents. We buy $100,000 loan for 85,000. We may only recover 90. Then we've gotten $5,000 profit, plus there's $10,000 that we can file a claim on.
Got it. Very cool. And that product is not quite out yet.
No, by the time your listeners hear this, it's going live at the last day of August. And I'll tell you, the big reason we're going for the government-backed loans, or a big driving reason, is as an insurance company, we can become a member of we're eligible to become a member of the Federal Reserve Bank. And this will allow us to, this will provide us access to extraordinarily inexpensive leverage. Today it would be less than 0.5%. Wow. But they won't take just a regular non-performing loan as collateral, but they will take at least the Federal Home Loan Bank of Boston and did I say Federal Reserve? It's the Federal Home Loan Bank is the one that we're eligible to be a members of, and we're planned to apply for membership in the Federal Home Loan Bank of Boston, and we expect that they will at some point allow us to pledge our mortgages, which have the federal government backing, and lever those to some extent. And again, that very inexpensive leverage married with the 7% crowdfunding equity that we raise should make us very, very competitive in terms of our cost of capital to buy these mortgages.
Good stuff. You are a raging entrepreneur, my friend. I'm always just impressed. Every time I think I'm an entrepreneur gone wild, it's like I have George on, and I'm like, I am tame. I'm a very tame individual compared to you.
No, I have a few. I'm trying to. I mean, the good news is these companies are all complementary. So PreReo, people that buy these mortgages or mortgages that are purchased by AHP Title, they all get serviced at AHP Servicing. So everything kind of interconnects, and that's what we're trying to build, is something where everything complements and supports each other company.
Fantastic. Well, George, I want to thank you for being on Wealth Formula Podcast again and again. Right now, we've got PreReo.com that's live. People should check that out. It looks like a really good opportunity to get involved with really nice properties too, right? I mean, obviously, you're talking about multi-million-dollar properties. You're not just talking about, junky stuff. So maybe you'll even find a place to live on PreReo.com if you want. But George, as always, a pleasure, and I'm sure we will have you on again in the near future.
I look forward to it. Thanks, Buck.
We'll be right back. Welcome back to the show, everyone. I hope you enjoyed it. Of course, George is a very, very smart guy. I love having George on the show. He's a longtime supporter of Wealth Formula. I'm also a longtime supporter of George. Big fan. He is the ultimate entrepreneur, and it's fun to watch him. At any rate, I think, what do you take from this? The thing that I would recommend that you do is I think you listen to a lot of different perspectives. I mean, listen to me, sure, but listen to others as well. And if nothing else, what you want to try to do is try to piece the facts together and try to understand why people have the opinions they have. If you're listening to this show, chances are you're a really smart person. I mean, you're probably, some kind of a professional, maybe you're a doctor or a lawyer or business owner that's really savvy, whatever. This is not over your head. You just need to kind of learn what people are talking about and start making your own decisions, right? Personal finance, we've talked about it before, but it's really, again, it's personal. And handing this off to somebody and saying, you know better than I do, and, just do what you think, I don't think is a really great way to approach your personal finances. I really don't, because, think about the wealth advisors and stuff. They're not doing anything differently. And the reality is a lot of them aren't thinking at all. So listen to what we're talking about. Listen to what George says. Listen to what I say. We're not always going to agree on stuff, and make your own decisions on a way to proceed. For me, I just don't think I can predict the future. And I think that we're in a very positive asset, the direction the asset markets are up right now. And I think they're going to continue to be that no matter what the frenzy is over the next few years. And even if they're not, I think for me, the idea is, just buy and stuff and improve it and increase and create equity. We don't have to just sit there and wait and hope. Buy and hope is not a good strategy in investments. And that's what most people do. We want to do is we want to buy and create equity and create wealth. Anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.